Good morning and welcome to the Killik Co market update. This week we've been anticipating the arrival of Hurricane Florence on the coast of Carolina in the US, and that's expected to move inland over the course of the next week, and it could be very damaging to properties around that area. So what are the potential impacts on the markets? Well, one potential impact is on the price of gasoline. We already know that people have been told to evacuate the area. That means everyone's been topping up their cars and driving away. That's caused a spike in the demand for gasoline, so that has caused the price to go up. And also, if the hurricane comes in and causes damage to oil refineries, as was the case with Hurricane Harvey last year, that will mean the oil will not be able to be refined into gasoline. Therefore, we could have a potential supply shortage, and again, that could push the price higher. So that's one potential impact on the markets. We've also had reports of another storm coming in and heading for the Gulf of Mexico. And around there are lots of oil production facilities. So if any of those get damaged in the storm, that could cause a decline in the supply of oil, and that could potentially push the price higher. So that's definitely worth keeping an eye on. Other impacts on the markets could be those relating to the property and casualty insurance sector. If the hurricane is particularly costly for them, it could cause a decline in share prices. So let's have a look at the Dow Jones Property and Casualty Insurance Index over the last 10 years. And you can see a quite notable decline in this index around the time of particularly expensive natural disasters. So around about 2011, when we had the Japan tsunami and earthquake, you can see quite a notable dip in the index. And again last year when we had Hurricane Harvey and shortly afterwards the California wildfires. So those two events were very costly for insurers. And if Hurricane Florence is anything like those, it could be bad news for the insurance industry. And this week has been a particularly tough one for the retail sector. It's only been a few weeks since House of Fraser went into administration, but this week there have been lots of rumours going around that Debenhams is also getting into difficulty. Particularly there have been rumours that the company had called in consultants to help with a potential restructuring. The company has rushed out a trading statement this week, confirming that it's not doing that and that it's not in trouble, but the share price does show that investors are very worried about the future of Debenhams. So let's have a look at the share price over the last 5 years. As you can see, back in 2013, the price was over £1. Today, it's just over 12 pence. That's the lowest it's ever been, and that does show that investors are very worried about the future of Debenhams. John Lewis as well released a trading update this week in which they said that their profits had declined 99% in comparison to last year. So that does show they're really struggling as well. And one quite interesting point within their statement was that one particularly weak point for them was homewares. Because people are moving house less, because house sale volumes are declining so much in the UK, that means people are spending less on homewares, and that's been bad for John Lewis. So we did already know that because of higher stamp duty levels and because of concerns about Brexit, volumes of house sales in the UK have been declining, but it's quite worrying to note the knock-on impact this is having on the retail sector. So retail at the moment is a very difficult sector to invest in, not just in terms of shares in the retailers themselves, but also perhaps in terms of shares in commercial property funds that are exposed to the resale sector. So I think this is very much a sector that needs to be treated with caution. And last of all this week, it has been the 10-year anniversary of Lehman Brothers going bust. There has been quite a lot of debate about whether or not the government should have allowed this to happen. But what you can't deny is that the fact that the UK and the US either bailed out failing banks or allowed them to go bust has put their banking sectors in a much safer place today compared to where it was 10 years ago, and also compared to the banks in other economies where the governments did not allow those banks to go bust. So one way of measuring this is by looking at the non-performing loans ratio. And this just looks at the ratio of loans that the banking sector in one country has on which the interest is no longer being paid by the borrower. So the lower this number, the better. So as you can see by this chart here, the ratio in the US is very low at 1.7%. In the UK, it's even lower at 0.8%. In the Eurozone, however, the ratio is much higher at 3.7%. In Italy, much higher at 13.2%. That's because Italy did not bail out bad banks or allow them to go bust during the financial crisis. And that's one reason why investors are particularly worried about the Italian banking sector at the moment. So definitely a situation there that's worth keeping an eye on. Now moving on to the week ahead, a fairly quiet one again, but we are looking ahead to results from Ocado. That's it from us. Have a great weekend and we'll see you next Friday.